What's going on, guys? In this video, I have some tidbits from Indi's earnings call that I'll feature for you guys. I'll also leave a link to the full earnings call down below. I highly recommend you listen to it. And Indi absolutely sold off. And we're going to go over why in this video, but mostly it's due to a weak forward guidance. They are actually expecting a dip in revenue in the upcoming quarter. But we're going to go over Indi's earnings. We're also going to look over the chart. And I do have a couple of bits and pieces from the earnings call that I will feature at the end for you guys. And for those that are wondering, I did buy some Indi today. I rolled out my $16 covered calls for CleanSpark into 2250s expiring mid-March. And with the premium I received, I bought some Indi shares. But looking over their earnings, and by the way, I'll leave their press release down below for you as well, along with the earnings call. They posted a record quarter of revenue, $70.1 million, up 112% year over year and 16% quarter over quarter. They expanded their non-GAAP gross margin to 52.7%, which is up 50 basis points year over year, and they delivered $223 million in revenue in 2023, which is up over 100% year over year. And they extended their ADAS, or Advanced Driving Assistance systems, user experience, and EV design win pipeline. Now, on a GAAP basis, their fourth quarter 2023 operating loss was only $20 million, compared to $29 million a year ago. Their non-GAAP operating loss was $2.4 million compared to $15 million in the same period last year, which reflects higher revenue, improving gross margin, and operating expense leverage. From a per share basis, their GAAP loss was 9 cents, while non-GAAP loss was 1 cent. And as said by the CEO, we more than doubled our top line for a third consecutive year in 2023, driven by increasing global demand for Indi's highly innovative semiconductor solutions, spanning virtually all leading tier 1s and vehicle OEMs. Further, we're at the unique intersection of vehicle safety systems, sensor fusion, and artificial intelligence towards realizing our vision of the uncrashable car. Now, looking over some business highlights, they are recognized by Morgan Stanley as the fastest growing semiconductor company in the world over the past 2 years among 224 global suppliers. They also entered a strategic partnership with Ficosa, and this was pretty recent. They also unveiled breakthrough computer vision processors, enabling viewing and sensing capability at the vehicle's edge. They captured in-cabin monitoring programs with BMW, Ford, GM, and Toyota. And they secured smart connectivity wins at one of the world's leading EV OEMs. Now, going over why I think the market sold this off so much, for the first quarter of 2024, we expect Indi's revenue to be up 38% year over year. That's great, but down 20% sequentially or quarter over quarter, reflecting market seasonality and current industry softness. Looking forward, based on our new product pipeline, we anticipate Q1 to be a trough quarter, meaning the lows in terms of revenue, but with top line recovery in Q2, and a resumption of outsized sequential growth in Q3 and Q4, yielding a profitability baseline in the second half of this year, ahead of our significant radar and vision ramps in 2025. You know, while it's definitely unfortunate they're giving a weak guidance in terms of the upcoming quarter, the quarter we're in, and not seeing substantial revenue growth until the back half of the year due to seasonality, but I am taking this as a great opportunity to continue to load up on Indi. And I think over the next 3 months or so, we will have a great opportunity to continue to add. For those that don't have a position yet, a great chance to scale in, build a position out. But let's look over the chart, and then I'll leave you with a few bits and pieces from the Q&A. Now, as I said earlier in those earnings remarks, they are expecting a dip in revenue. We reported this quarter $70 million in revenue. Upcoming quarter, the quarter we're currently in, is going to be a $59 million quarter. So a dip in revenue, the first time this company has seen revenue dip since it became a public company. This is the first time we're seeing a dip in revenue. Now, from a chart perspective, I believe we're going to continue seeing this tightening pattern. And over the next 2-3 months or so, we're just kind of going to be range bound most likely. Maybe we'll test the low here. Great opportunity to buy potentially under 5. But you'll see that right when Indi starts getting back to that revenue growth, that could be a very likely point where we start breaking out of this pattern and seeing a huge run, seeing the golden crosses, seeing the bullish charts again. I do think we'll be stuck in this descending wedge for a couple more months. But I do believe it'll be a great time to load up on Indi. I am taking advantage of this fear. Let me know if you guys are buying right now, if you even know what this company is. I know a lot of people don't know about Indi Semiconductor, but for those of you that don't, I highly recommend you go look at their investor relations tab, check out their little presentation, get an idea of who they supply chips to. But I really do think it's a great opportunity to buy some Indi on this weak guidance. And before you know it, we're going to get into late 2024. They're going to see that revenue ramp back up, and they are going to get to profitability. But now I'll leave you guys with the earnings call. Thanks as always for watching, and have a good weekend.
Operating expenses were $39.4 million, with R&D sequentially lower to $29.4 million, reflecting a pause in tape-out activity, while SG&A was down slightly quarter over quarter to $10 million. In turn, our Q4 operating loss narrowed to $2.4 million versus a loss of $15.1 million in the year-ago period, driven by higher revenue, improving gross margin, and operating expense leverage. Adding back $1.4 million of depreciation, our EBITDA loss was less than $1 million. With net interest expense of $200,000, our net loss was $2.6 million, and we posted a 1 cent loss per share on a base of 181.6 million shares, again in line with our guidance and consensus estimates. We exited the quarter with $151.7 million of cash and equivalents, down $9 million versus Q3, primarily related to increased AR and CapEx to expand our internal test capacity, partially offset by a decline in inventory. Turning to our outlook, for the first quarter of 2024, we expect Indi's revenue to be up 38% year over year, but down 20% sequentially, reflecting seasonality and current industry softness, with gross margin in the 52% range. From a full year 2024 perspective, we expect revenue to be in the $275 to $300 million range, up 29% at the midpoint. Based on our new program and design win pipeline, we expect Q1 to represent a trough quarter, with top-line recovery in Q2 and a resumption of outsized revenue growth in Q3 and Q4, yielding a profitability baseline on an EBITDA basis in the second half of this year, ahead of our significant 2025 radar and vision ramps.
Our next question is from the line of Anthony Stoss with Craig-Hallum Capital Group. Please go ahead.
Maybe if you can give us some color on kind of expected new programs coming online Q2, Q3, Q4 that gives you the confidence for kind of a steep ramp in Q3 and Q4. And then also as my follow-up, probably for you, Donald, again, I think that large radar win, your prior statements were Q4 or Q1 of 2025. Now you're saying 2025. Do you still expect it to be in Q1 2025, or is that getting pushed as well?
No, that still remains on track. I mean, that's perhaps just the semantics of the notes that we made in the prepared remarks, so nothing has changed in that respect. In fact, we did announce that we had sampled these programs, and as you know from all your experience in this market, the back of the program is largely broken once you get to first silicon, and the rest of it is really execution of maybe more the details of ramping into production. So we're pretty happy where that program is right now, and we do expect some material revenue from that to come in on the schedule that we originally outlined. In terms of what we're ramping across the board. There are vision programs that are ramping. There are user experience programs that are ramping throughout this year. Not radar, of course, that will be late this year, early next year. But yeah, I mean, it's still fundamentally across the board in all of the other project areas that we're servicing right now.
Our next question is from Cody Acree with the Benchmark Company. Please go ahead.
Yeah, thanks guys for taking my questions. I guess given the magnitude of the decline in Q1, what is giving you confidence that you're going to see a ramp to support your fiscal year outlook? What are you expecting sequentially as you push through the year?
We have programs ramping through the year, of course, which has been typical of us through our entire public existence. And as I just mentioned in answer to the previous question, for sure, we do expect the market to recover, and I think you will see that message coming from multiple companies in the same space as us, that they are seeing through that period a recovery. I mean, in particular areas in the market, we did see what I would describe as fairly dramatic air pockets. We've tried to be conservative in the way that we've guided Q1, and as a net result, we're pretty confident about a recovery in Q2 and a return to the plan in Q3, Q4.
And I guess, Donald, is that confidence backed by firm orders today? And I guess what's the flexibility or cancelability of those orders? I guess how much volatility are you building into your Q2 expectations?
Well, like I say, we've tried to build in as much conservatism as we possibly can. I mean, this has been in certain segments, a fairly violent disturbance in the market. But we do expect that with the recovery that we're seeing, coupled with the conservatism that we've built in, we feel pretty confident about where we can get to in the second half and in Q2 indeed.
Our next question is from the line of John Tanwante with CJS Securities. Please go ahead.
Hi, this is Justin on for John. Thanks for taking the questions. How does the updated outlook impact your expectations for cash flow and your capital needs?
Well, between now and what Donald just outlined in terms of the back half of the year, cash flow will resemble our operating loss. So you can assume somewhere in the $35 to $40 million range of cash usage between now and then until we're beginning to generate cash, that is. And of course, we just exited with north of $150 million in cash. So that leaves us with ample cushion.
Can you talk about the scale of the wins that you had in Q4 and, try to size them for us if any of them are, significant?
Well, the one that we'd single out is the design win for Ficosa, who are a European-based tier one, and as such supply with this particular program two of the largest European OEMs. It's a program that we've been working on for quite some time, and I wouldn't say it was the largest program that we've won in the history of the company, but certainly in the top 5.